This episode is brought to you by Mortgage Workflow Partners and the Mastering Encompass series, both for users as well as administrators. You can find out all the information about it over at masteringencompass.com. Also, if you'd like to check out what we're doing on YouTube, go ahead and subscribe to the channel using the @MasteringEncompass handle. And make sure you stay up to date on all the information, not just with podcasts, but also video content that we bring to you as often as possible. Now let's get on to the episode. Hey everyone, Larry Bailey here with Mortgage Workflow Partners, bringing you another weekly market update. Today is April 1st, 2025. We're going to be going through what happened in the market for the week of March 24th. I hope that everybody has pranked you well enough for today, and if they haven't, watch out behind you. You never know what's going to happen. Let's get into what's going on here. So last week, we saw the Federal Reserve's key inflation gauge move in the wrong direction in February, which is a concerning development. However, signed contracts for new and existing homes rebounded after a sluggish start to the year. Home prices nationwide continue to show solid growth. Here's the stories we're going to go through today. First is the Fed's preferred inflation gauge ticks higher. Then we follow that with new home sales bounce back after a slow start in 2025, followed by pending home sales improve. Then we get into how home prices maintain solid nationwide growth. We've got some also of note things to go through there. We've got a family hack of the week to look at, and then we're going to talk about what happens for this week. If you're listening to me on podcast, thanks very much. If you want to check out everything that's on screen here as we go through, head over to masteringencompass.com, head over to the community. Guys, if you know anybody using Encompass, use masterencompass.com. Like seriously, what are you doing? Where are you going for your information? Because it's not at that place if you're not there. Also, check out the AI chatbot. A lot of information in there that helps you guide you through how to leverage your Encompass platform like a master. Let's get into these stories here. First one is the Fed's preferred inflation gauge ticking higher, and we see on screen we've got personal consumption expenditures. We see this where we were going down, then we kind of ticked up and then down up, and here we go. The latest personal consumption expenditures, that's the PCE report, showed that the headline inflation was in line with estimates, rising 0.3% from January to February and 2.5% year over year. Not too bad. However, the core PCE rate, that's the Fed preferred way to measure that, which strips out volatile food and energy prices, that was hotter than expected. That was up 0.4% from the prior month, or 2.8% year over year, still stubbornly above the Fed's 2% target. Costs for utilities, healthcare, computer software all rose more than expected, contributing to that elevated inflation reading. Shelter costs were a bright spot, though, go figure, as they continue to catch up with softer real-time rental data that we've seen compared to the more elevated government figures that we've been using historically. Bottom line for this whole story is that the trend of annual core inflation raises concerns, particularly as it's assessed on a rolling 12-month basis. And this is wild because last year at this time we were saying, woohoo, hey, how great this is that it's on a rolling 12-month basis. But now, shoes on the other foot. This means that the total of the past 12-month inflation readings will determine the year-over-year rate. If you look ahead, lower readings for April through December 24 could prove challenging to bring inflation back to the Fed's 2% target if they're replaced by higher numbers as the year progresses. It's all math, people. It's all math. What's also important is also worrying was lower than expected consumer spending in this report, because consumer spending fuels the U.S. economy to the tune of 60 some odd percent last time I heard. This, combined with sticky inflation and record high credit card deficit nationwide, this is all going to add fears to an economic slowdown. See what happens. Stuff's about to get real, I know that. New home sales bounced back after a slow start to 2025. So we see a graph on screen here from new home sales. And so after a disappointing start to the year, new home sales rebounded in February, rising 1.8% from January to a 676,000 unit annualized pace. And this rebound would have been even stronger, but we had inclement weather in the Northeast, which dampened activity in that region. That's my region. I'm in New Jersey. So on a year-over-year basis, sales were up 5.1%. January's sales figures were also revised higher, just so you know. The median home price in all of this, that dropped 3% from in January to $414,500 in total. But it's important to note that this dip was not due to a nationwide decline in home prices. Remember, guys, The median sales price represents the middle-priced home sold, not the average. Again, it's all math. I told you. This median can be influenced by the mix of homes that get sold each month. So in this case, the decline in sales of the more expensive Northeast, aka New Jersey, and the West regions, aka California, shifted the median prices slightly lower, even as home prices continue to rise across the country overall. Bottom line here is a limited inventory of existing homes combined with strong buyer demand has shifted focus to the new construction market. However, more inventory is needed to fully meet this buyer interest. As of February, there were only 500,000 new homes available for sale. But get this, only 119,000 had actually been completed. The rest were still under construction or were just dirt. I have 60 units out in front of me right now that are being constructed for the last 2.5 years. It's just dirt still. But those are considered to be somehow available inventory. I don't know. I don't get it. Here we go into the next story. Pending home sales improve. We've got a nice graph over here where, again, we've been watching this thing. And so after 2 months of declines, the pending home sales rose 2% from January to February, according to the National Association of Realtors, also known as NAR. This metric, which tracks signed contracts on existing homes, typically precedes closings by 1 to 2 months because it takes that while to close, if you're getting a mortgage at least. And it's a key indicator of housing market performance, historically speaking. So the bottom line here is the rise in signed contracts comes from a historically low baseline, with much of the increase attributed to the South, where severe winter weather in January likely dampened and delayed transactions until February. This trend aligns with recent reports on new home sales and existing home closings, both of which displayed improvement following a sluggish January. There you go. This next story, home prices maintain solid nationwide growth. And this is on screen here, we've got a Case-Shiller home price index, and it's definitely showing increases. And this is a closely watched price index. It's called the Case-Shiller. It's considered to be the industry standard or the gold standard for measuring home value appreciation that reported a 0.6% increase in home prices across the country from December to January after seasonal adjustments. On an annual basis, home values rose 4.1% in January, building on the 4% gain we saw in December. The 10-city composite index posted a more robust 5.3% year-over-year increase. And while the 20-city index saw only a 4.7% rise, this all indicates stronger growth trends in major urban markets compared to the national average. It's where the jobs are. It's what I know. I mean, I don't know. I've only been doing real estate now for 30 years, and my father was in real estate before that. Your real estate is going to go up where the jobs are. I know one of my daughters lives in the greater Seattle area, in the area that she just got an apartment in is where Microsoft and Facebook are. And so, do the math on if you think apartments are more expensive there versus other parts of Seattle, outside of downtown. Obviously, downtown is ridiculous, but anyway. Yeah, go where the jobs are. So, separately, the Federal Housing Finance Agency, as known as the FHFA, that house price index showed a seasonally adjusted 0.2% increase from December to January, with prices 4.8% higher than the previous year. Remember, unlike the Case-Shiller, the FHFA's measurement excludes cash buyers and loan amounts that are greater than the FHFA limit, focusing solely on conventional mortgage financing that FHFA watches, like things that can go directly to Fannie Mae or Freddie Mac, things like that, or FHA or VA or USDA. Homeownership remains, bottom line here, gang, homeownership remains a solid wealth building opportunity. As an example, a $600,000 home appreciates at 4%. In a year, would see a 24% gain. If you sold it, obviously it's a good return. There you go. So when we look at other things here, this is also of note feature. It's important to remember something, that the U.S. economy experienced solid growth in 2024. It's really important to remember that. I know a lot of folks thought 2024 was a year of problems, but when it comes to the U.S. economy, if you agree with and support the measurements of the economy, the GDP increased by 2.4% in just the fourth quarter, which was slightly higher than the initial 2.3 estimate. This capped off a year with growth of 1.6% in quarter one, 3% in quarter two, 3.1% in quarter three, and then, like I said, 2.4% in quarter four. The Q4 uptick was driven by increased government and consumer spending, though investment declined. And this is important because when we look ahead, the forecast suggests that the economy has slowed down for the first quarter of 2025. The Federal Reserve will be closely watching the first quarter gross domestic product (GDP) data, which is set to release on April 30th, the end of this month, as they weigh future monetary policy decisions. On the employment front, the initial jobless claim, that's what I got, unemployment in my head, that held fairly steady at historically low 224,000 U.S. citizens. However, continuing claims remained elevated above 1.8 million, dropping 25,000 to 1.856 million people that continue to receive unemployment benefits. This, as a reminder, this suggests longer unemployment periods for job seekers, a trend that's persisted since June of 2024. So we'll see more information on that to come, I'm sure. Family hack of the week. So if you're listening to me on podcast, on screen, there's a decadent dark chocolate mousse from the Food Network. This is a perfect way to celebrate the National Chocolate Mousse Day on April 3rd. I love how every day is something, right? So there's the recipe on screen. Check it out. And let me know how it turns out if you make it. Here's what we're looking for this week, gang. We're going to deliver a whole bunch of insightful information for the labor sector with key reports coming out. On Tuesday, we'll see updates on job openings, followed by private payrolls on Wednesday. Thursday brings unemployment claims, and then we'll wrap up the week with the non-farm payrolls and the unemployment rate on Friday. And there you go. That's what's happening. My name's Larry Bailey. Thanks for listening to these. Hope you have a great rest of your day, and we'll see you over at masteringeencompass.com. Thanks much. See you now. Bye-bye.